we go. Okay. So today's class, we're going to be doing two things. We're going to look again at the DuPont analysis, and then we're going to do valuation using multiples. And the stuff that we do today, where's my iPad? Here we go. The stuff that we do today is going to be very helpful for your assignment. So your assignment will be very much what we do today, but just sort of blown up into more detail. Let me keep the chat open. If anyone's got questions, then just put stuff in the chat. Okay, so I'll start off. How do I stop sharing? Oh, there it is, stop sharing. Okay. So I just want to share my own screen quickly. Where's my notes? Here we go. Okay, there we go. So again, where's my chat? So if we just take a step back where we came from last week, so the price of a share today is D1 over R minus G. So that's what we did last week. And then we said G equals, so the growth rate is ROE times B. So the return on equity times the retention rate. And then ROE itself is split into the DuPont ratio. So net income over sales times sales over total assets times total assets over equity. Okay. And then these ratios themselves have names. So the first ratio is the net income margin. The second ratio, total asset turnover. And then the third ratio is equity multiplier. Okay. So what the DuPont analysis says is that return on equity is very important. It drives how a company performs, how it grows, and growth is important in valuing a company. And the DuPont analysis also looks at just what are the things that sort of drive a company's performance. So when you're analyzing a company, it's a really nice place to start because it's just, there's all this information about companies, like how do I know how well it's doing? So I find that DuPont is a great tool. So for your assignment, you're asked to do the DuPont analysis and then comment on the DuPont analysis. So we're going to do a simplified version of that now in class. So we'll do an example with for Walmart. So that's why we said in the assignment instructions you shouldn't choose Walmart. So if you look, I posted on Quercus the problem set for today. So let me just stop sharing here. And move to this one. Okay, so you can see what I'm seeing. See, I've got screens all over the place here now. I can't see things. Oopsie. Where's my chat? Okay, we're still good. Okay, so on Quercus here, your questions for today are posted here. and you'll see, oops, wrong one. That's the tutorial. This week's class, here we go. Okay, so the first question is DuPont analysis, and then we're going to do another question valuing Walmart. So we're going to use Walmart in both of the examples, and we're going to do a valuation of Walmart using multiples. So let's start off with the DuPont stuff. So I've prepared a skeleton for you. Here we go. So just download this. Okay, so let me share my next screen. If any of you ever get these hashes here, it's just because your columns are not wide enough. So if you go between column B and C and just double click, it'll automatically size it for you. That's just another Excel tip. Okay, where's my spreadsheet gone? Okay, so what I've done here is I have given you a few years worth of data just to save you time. So this data here, I pulled all of this from FactSet, and for your assignment, you would do the same thing. But I didn't put in the January 2025 numbers because I thought it was helpful just to show you where that comes from. Make this a bit smaller so you can see the whole screen. Okay, so you'll have access to FactSet for the assignment. As I mentioned last week, you've got, and we've requested licenses for everybody, but this information also comes from the company's actual financial statements. So I want to show you how to find that through the financial information for Walmart. And you'll see here they've got information for investors as one of the options. Financial information, that's what we're looking for. And then there's a whole lot of stuff here below for all the different company reports. So we want financial results, and we want annual reports, and we want the most recent annual report. So 2025 will be their most recent annual report. So if we click on that, let me go to my other screen now. Yeah. Okay, so this is a PDF of the annual report for Walmart. Those of you that are doing MDT 220 at the moment will have seen this with Leon's, but some of you aren't doing 220 at the moment. So you'll see there's a whole lot of information about the company. And when we get to page 3, there's something called a Form 10K. So the Form 10K is all companies that are listed in the US, their annual report is called a Form 10K. And it has a very standardized format. So if we scroll down, the font is the same. It doesn't matter what company you look at, it'll always look like this. And then it'll have a table of contents, and these are all live links. So it'll tell you about the business. And then you'll see here item 8 over here. This is the annual report, and it's always item 8. So if I just press Control, it should take me there. It doesn't take, this isn't a live one. So we'll go to page 49. 47, page 48, page 49. So this is where it gets to the income statement, balance sheet, and so on. And the information we need for our spreadsheet, if we just continue, here's our income statement. So if we look at the, if you just go back to the spreadsheet, that hopefully you've got open in front of you on your own screen. So if you just toggle to the spreadsheet, you'll see that these numbers here I've captured for you, and I'll use total revenue, not net sales. So can you see that? So the net sales figure is the 680. So that, if you just go to your spreadsheet and just put that in, I'm going to put it in now, and then I'll share my other screen once I'm done. So it should round up to 681. Okay, then the net income, if we go down the income statement, so the net income we've got, can you see there are two net income numbers? There's this 20 billion, and then there's a 19.436 billion. So if you can just, I'm going to show you what that means. If I can just find, I've got so many things on my screen, I can't actually find you. Here we go. Okay, so let me explain to you what those two different levels mean. So you'll see there's net income, and then there was the net income attributable to Walmart. Actually, it's probably easier if I just do it from here. Where's my screen gone? Just do it from here. Okay, so what this means is if a company like Walmart, let's say, just take out my name here. Okay, Walmart owns a subsidiary. And let's say it owns 90% of the subsidiary, so it controls it. There must be some other people who own the remaining 10%. What happens when you've got, so this is getting into consolidations, which is an advanced accounting topic, but it's just helpful to understand where these numbers come from. So when a holding company, so Walmart in this example would be a holding company. So if a company controls a subsidiary, and control is usually 50% plus one, what it does is it consolidates all those little subsidiaries. And by consolidating them, it basically means you just add everything together that's sitting at the bottom. So Walmart will have, let's say, a store that's a subsidiary, and they own 90% of that subsidiary. Someone else owns the other 10%. When you look at the financial statements of Walmart, it's going to include all of the subsidiaries at the 100% level. So these numbers here, this net income before tax, all of this stuff is at the 100% level. But because Walmart doesn't actually own 100% of the subsidiary, they need to remove that 10%. So this 10% over here, this needs to come out. And the place that it comes out is over here. In this, it's called non-controlling interest over here. Okay, or we call it NCI sometimes. So the income that we are interested that we use with when we're doing our ratios, you need to compare apples with apples. So if we are working with income after you've deducted the non-controlling interest or these other people, if you're using income, so that's why they say here net income attributable to Walmart. If I'm using that income, then it's got to be matched with it's got to be matched with other items that are also net of the non-controlling interest. So in particular, we do this with the with return on equity. So return on equity is net income over equity. So we just need to make sure we are using the right net income and the right equity number. So the way I set up this example was to use the net income. So the 15.5 is what I've got in my comparable year, and the 11.6 is what I've got in the other comparable year. So we want to be consistent and do 19,436 for my net income number. So I'm going to put that into my spreadsheet, 19.436. Okay, and then when we do our balance sheet, so if we go down to the balance sheet, so if you remember, our return on equity is net income over equity. And this net income number is after non-controlling interest. So my equity should also then be after non-controlling interest. So if we look at shareholders' equity, we can see that, again, that there are two items here. There's total, oopsie, that is not what I'm looking for. Total shareholders equity of 91, and then there's also a total shareholders equity of 97. So which one should we use? Let's think about it. So we've got Walmart owns 90% of the subsidiary. We took the after non-controlling interest at the net income level. So at the equity level, we must also do it without non-controlling interest. So we actually do it at this level here. So you can see that is smaller than the 97. So that the 97 is at the 100% level. So the 91 is at the 90% level, which is excluding the non-controlling interest. The 97 is at the 100% level. So we want to compare 90% with 90%. So we're going to put in for our shareholders' equity 97. Sorry, 91. After all of that, I got it wrong. 91.013. Okay, and if you look at the prior year, the 83 is what I had in the spreadsheet for the prior year. Okay, so those are my inputs. Oh, we've got Timmy, you've got your hand up.
Hi, Prof. I didn't quite get basically we are saying that if we get like for 90% for the previous numbers, we also get the 90% for the return on equity. Okay.
That's
So
right.
so we can compare 10, 100 on the other side and 90 on the other side.
Exactly.
Okay.
So when you go into FactSet to do your assignment, they'll actually have done all the calculations for you. So you don't need to worry about like grabbing it yourself because you don't have to do the calculations. But I just wanted to show you just to like layer in a little bit of an explanation of where the numbers come from.
Okay.
So
Thank you for
Pleasure. So on FactSet, when you call up the ratios on FactSet, I've got a screenshot in the assignment instructions. If you actually click on the particular ratio, you'll see it's in blue. And if you click on that, it'll give you a pop-up window which shows you where the numbers come from. So if you find something doesn't make sense, whatever, you can actually see how they've done their calculations. You can sort of track it all the way back. It'll take you all the way back to the 10K.
Okay.
Okay, good question. Okay, so I'm going to share the spreadsheet now. Drag it into my window. Feel free to shout out if I'm going too fast or you've got a question, because sometimes I've got 3 screens here, so sometimes I miss if someone's got their hand up or something. Okay, so I filled in these 3 numbers as we were looking at the 10K. And that's all. Those are the 3 inputs that we need. Oh, total assets. Sorry, I didn't do total assets. So total assets was we didn't have to worry about non-controlling interest for that. So that's 260.8 was from the 10K. You can just put that number in yourself. Okay, so we've got the 4 numbers that we need to assess this one. And then everything else is calculations. So my increase in revenue will be the increase from 248 to 681, and the formulas are all there for you already, so we can just copy those across. Okay, so that's my increase in revenue. The increase in net income also, we can just copy that across. The formula should be set up correctly. Okay, then the net income margin. So this is net income margin is net income divided by revenue. So let's just do that manually ourselves. Divided by revenue. Okay, then asset turnover. So I think I did mention this in the videos, but when we're comparing a balance sheet number to an income statement number, we always take the average of the opening and closing for the balance sheet number. So asset turnover, again, the ratio. Where's my pen? So asset turnover is sales over total assets, but total assets needs to be an average. Okay, so asset turnover would be sales divided by my average total assets. So we need 2 brackets there. So it's this year plus last year, close bracket divided by 2 is 2.65 times. Okay, and then equity multiplier again is balance sheet number, so we've got to do averages. So it's so actually let me just write it. So equity multiplier again is here's my equity multiplier is total assets over equity. So total assets is this year plus last year divided by 2, and all of that we've got to divide by my average equity. So we'll need 2 brackets for that. Equity plus last year divided by 2. Those brackets. Okay, and then Let's just clear these drawings out the way. And then return on equity, so let's just calculate it both ways. We should get the same answer. So one way to calculate return on equity is net income times asset turnover times equity multiplier, so the DuPont way. So it's net income, okay, sorry, net income margin. So it's that times by asset turnover times by equity multiplier. Okay, so that's one way to do it. And the other way to do it would be from the beginning, net income divided by average equity. So again, we've got to do this average exercise. This year plus last year divided by 2, close brackets. And we get the same number, so that's good. So I'll just give you a minute or so to catch up. A couple of people can just let me know in the chat if you're up to date, and then we can talk through the comments. I'm just going to grab a glass of water. I'll be back in a second, so you finish populating this quickly. Okay, can you write the formula in the text? Yes. So which formula, which one did you want, Miriam? Net income margin, okay. So if you look, actually, Miriam, if you go into the spreadsheet and just look to the cell to the left, you should see the formula. Can you see that? Does that help you without me having to redo it, or do you want me to put it in? I'll put it anyway. Just so you know, all of these are formulas that are in the spreadsheet already. Okay, great. Write the formula for the ROEs. So the formulas for the ROEs are over here. And then also if you go into the cell, I'll just put it in here as well for you. You're getting 22.19. Oh, okay, maybe there's, did you do the average? I wonder, there was something, I wonder if my spreadsheet is different from yours. Did you average the, for both of them, are you getting both box are you getting 22.19? Huh. Did you download the spreadsheet yesterday or today? Because I found an error in the spreadsheet yesterday. Today, okay. I don't know why we are getting different numbers. Okay, let's go line by line. Oh, it's asset turnover and equity multiplier. Okay, so here, can you see what I've done? Does that make sense? What do you get for asset turnover? Maybe a rounding thing, when just the way we captured it. 1.76. And just look at mine. So it's 681, 2.65. So 2.65 is the correct one that Vasilia's got. So Rima, just check where your brackets are, that you've got everything bracketed correctly in the, yeah, okay. Okay. And who else was there? Yeah. Was it the brackets for the net income increase? Okay, so Shirai, ROE is different, 22.19. It might be just because I put in for total assets, what did I capture? 260.8. Did you put in a more decimal places in your total assets? No. And shareholders' equity, 91.013. Let's see if I put 91, what does that do? Doesn't really make a difference. I wonder why. So let's just check, which one did you get? ROE 22.19. Vasilia, did you get that for both ways? The formula text next to increase in net income. Okay. How does that help you guys? Did anyone get the same numbers as me? Timasang.
Prof, I got 22.19, but the only number that's different for me is the increase in net income, which I got as 25.2. But most of the time I just copied the formulas which was provided in the spreadsheet.
So did you have 648.1 for
Yes.
2024?
Yes, ma'am. I have 648.1.
And then 681 for
And everything is the same as yours, and except for the increase in net income, which I got 25.2. But still I got 22.19. And also in this regard, if we let's say our answers are not the same for the midterm, what is the margin of error? Is it like
Oh, so
what
I
is
won't
the
actually ask you to calculate. I don't think I'm going to ask you to calculate the stuff. I'm just thinking about it. Oh, maybe.
okay.
So we'll look at what your calculations are. Oh, but the
Okay.
increase in net income 25.4,
Mhm. and
you got, what did you get for net increase in net income?
I got 25.2, but I just copied the formulas in the spreadsheet. I controlled R
Right.
for that one.
It's so weird. And is it so if you go into the formula itself, so I think it's rounded. Yeah, I think it's because it's rounding.
Okay.
Yeah, I think that's what it just doesn't seem to be. Um, because I spoke to Professor Schumann after his classes yesterday, and he had the same issue. So I redid the spreadsheet, but I think it's just because of rounding.
Okay. And also I wanted to ask, why are we taking the average for average equity? Is there any
Okay.
specific reason why we're doing that?
Yes. So the logic for that. So Ariane, you just said, how did I get the last one? Let me just put that in here. Okay. So if you think of the way, let me just create a little bit of space at the bottom. If you think of the way this works, you've got, so for these guys, this is 31st of Jan 2024, and then 31st of Jan 2025. Okay, and you've got a balance sheet at the beginning of the year, balance sheet at the end of the year, and the income statement covers the whole year. So if you are comparing an income statement number like net income with the balance sheet number like total assets, there's this question of, well, which total assets number do I use? Do I use the beginning or do I use the end of the year? And so the convention is to use the average, because net income covers the whole year because it's an income statement. So you've got to, if you're doing income statement to a balance sheet, you need that point in time for the balance sheet. So one argument could be, well, I should use the beginning of the year balance sheet because those are my assets that have generated income during the year that follows. So if I start with my opening balance sheet, but then what happens if you like purchased a lot of assets at some point during the year, then they will have generated income. So that's why we use the average. That's the convention, is to use the average.
Okay.
Does that make sense?
Yes, ma'am.
Okay, great. Okay, so I think we're sort of all more or less in the same place. There may be some slight differences because of rounding, but I think we're close enough to see sort of directionally what's happened. So the interesting part here is not, I mean, obviously the calculations are important because it explains to us what's happening behind the scenes. But what we want to do as analysts is actually interpret what's happening here. So let's just go through this and see line by line. So we see with net income, well, let's look at revenue first. So revenue has grown, it grew slowly from 20. So we obviously haven't got a change number for 2021 because you need a prior year. We don't have the prior year number. So we've only got the changes from 22 onwards. So net income grew. So if we look at just Walmart on its own, net income grew slowly in 2022. Then I suppose with COVID, coming out of COVID, we saw net income grew strongly in 23 and 24, and then net income growth has slowed down in 2025. So it's hard to know, is that a good number or a bad number without looking at other companies in their industry. So that's why I've put the Costco numbers over here. So if we look at what's happening with Walmart over the last 4 years and compare it to Costco, so Costco revenues were growing very strongly in 2021 and 22. They were probably, my guess is, I mean, I haven't looked at Costco in detail, but my guess is they were probably aggressively opening new stores, going into new areas. And then in 23 and 24, the Costco revenue growth has slowed down. So Costco used to grow much stronger. The revenues were growing much stronger than Walmart's, but in the last year, they've sort of leveled out. So that would be some comments on revenue. Then if we look at net income, so net income, it's much better to look at net income as a ratio, the net income margin over here. So net income margin tells us how much profit we are making of every dollar of sales or every dollar of revenue. And we can see that Walmart's net income margin for 2025 is the highest that it's been for the last 5 years. It's pretty much, it's like increased from the last 3 years. So when I first started using Walmart as an example in class was in 2023, and I thought it was quite interesting there. Their net income margins were only 1.9% and had been declining from the previous 2 years. And I was wondering whether that was an opportunity for them to maybe redesign their business processes to improve their net income margin. And in looking at that, I compared Walmart to Costco. So that at this point in time, when Walmart was 1.91, we could see that the industry, they historically they'd been around the 2.4% mark, and comparing them to other companies in the industry, it seemed like 2.4 to 2.5% is kind of where the net income margins are in that area. So looking at this in 2023, I thought there was an opportunity for Walmart to improve its margins. We obviously need to understand like why their margins were down and what their strategy was to improve it. But just looking at it very superficially, it looked to me like there was an opportunity. And that's in fact what we saw play out when you then look at the next 2 years, see how their net income margins recovered. Costco's net income margins also improved over that period, but Walmart is really sort of catching up to Costco. So they're still slightly below Costco's margins, and they always have been. They pretty much always have been lower than Costco's margins. I suppose except for 2020, they were kind of on a par, but they're a little bit below Costco's margins. So maybe there's still an opportunity for Walmart to improve their margins, but the opportunity to improve margins isn't as big as it would have been in 2023. It's not as obvious anymore. So those would be some comments I'd make on net income margin. Then if we look at asset turnover, so asset turnover has been also improving slightly. It's sort of from 2.3 times. So asset turnover again is sales over total assets. So it's saying total assets is the capital you've got tied up in the business, and to what extent is that capital generating sales? And then net income margin says, okay, we've got sales. Are those sales profitable? So if you think of Walmart, so they're generating, improving sales over their asset base. If you compare them to Costco, you can see that Costco's asset turnover is higher than Walmart's, and has also been sort of improving slightly over this 4-year period. And if you think of what a Costco store looks like compared to a Walmart store, you can see why the asset turnover for Costco will be higher than Walmart, because a Costco is sort of a bare bones, basic box with concrete floors and everything sort of stacked up on pallets. Whereas Walmart is just a little bit more finished as a store than Costco would be. So Costco's got less capital tied up in the actual physical building than Walmart has, and so their asset turnover is higher, which is kind of what one would expect. So you can see the numbers reflect the business model. And then equity multiplier is, there's sort of not much here. Equity multiplier is sort of how much they are funded with debt, and they're kind of on a par with Costco. So it's sort of been fairly stable over the past few years, and not that different. So there's not much to talk about there. So if we look at return on equity, going back to where these ratios start, return on equity for Walmart has been improving. And that is being driven by the improvement in their net income margin. That's had the biggest impact, is the net income margin going from the 1.9% in 2023 to 2.85. That is a huge impact. It sounds like only 1%, but for a business like this, going from 1.9% to 2.8% is a very big jump. And that we've seen has had a very big impact on their return on equity over this period. And then if we compare Walmart to Costco, Walmart is 22%, Costco is 30%. What is the biggest reason for that difference? It's the asset turnover. It's 3.67 versus the 2.65. Okay, so the DuPont analysis is, you can just see from this discussion, we did the calculation, so we understand what the drivers are behind these numbers, but the ratios and the story that the ratios tell is what's interesting. So I wanted to just talk you through what the story is, just so that you can get a sense of what we're looking for in the assignment. And then if I was looking at buying Walmart shares, I would be interested in, is there a chance that they can improve things in some way? So let's say let me just copy this across quickly. Actually, I'm going to share my other screen because it'll be easier. Where's my Zoom button. There we go. Okay, so let's say we, these numbers here I've copied straight from the, from here. Okay, so it's these numbers here. Okay, these are the same as we had on the previous screen. So let's say we think revenue grew by 5.1% this last year. Let's say we want to play around with that and say, what happens if we can increase sales by 6% next year? And let's say our margins, our net income margin is 2.85% in 2025. So let's say, actually, let's just call this forecast for 2026. So let's say for 2026, we think that revenue can grow by 6% and we can have a slight improvement of our net income margin to 2.9%. What does my 2026 number look like? And assume that everything else feeds off this. So I can forecast my revenue, I can forecast my net income. Let's say my total assets doesn't change. And my average shareholders' equity, assume that doesn't change, then we can see what happens to my asset turnover and my equity multiplier and my return on equity. So you can see that if I can get this right, my asset turnover is going to improve, and my return on equity is going to improve as well. So if you were an analyst looking at Walmart, you would be looking at what management is forecasting for growth. You would know that net income margins are important for getting to your net income and your return on equity, and you would understand with Walmart that that their asset turnover is very important as a differentiator compared to Costco. Okay, so go back into my other spreadsheet. So this is sort of a kind of thing that analysts do when they are building forecast models for companies, for shares that they analyze. I just want to see if there's anything else on my notes that I had to say. No, where's my other screen? That was everything. So if you were advising Walmart, let's say you were a management consultant, and you were hired to do some consulting work for Walmart, what would you say to them? So I would probably say there's not huge scope for margin improvement, for net income margin improvement. Their margin is the highest it's been in the last 5 years. It's pretty close to Costco's. I don't think there's much scope for margin expansion. Where I think the opportunity is in their asset turnover. So if they can grow existing store sales, if they can increase basket size for customers. So these are terms that retailers will often use, especially grocery retailers. They'll talk about average basket size. So they want to get they want to get the same number of customers in the store, but they want the customers to spend more. And then looking at their revenue growth for the past 5 years, like I think it's not unreasonable to say a 6% revenue growth as well. Okay, so that would be how I would frame a DuPont analysis of Walmart. So I would look at Walmart relative to its own history. I would pull out the ratios, look for what is interesting and different, and I would compare it with other companies in the industry. So in this example, I just looked at Walmart compared to Costco. What you should do is look at it relative to at least 3 competitors. So, so in your assignment, we ask you to choose a company. You'll do your main analysis of the company, but you're going to compare it to 3 other companies. So you can get a feel. Like it would be useful here if I had the information for Target as well, and maybe like Kroger or something like that. It's like other similar companies, Loblaws, something like that. So the valuation that we're going to do next will be also looking at Walmart, and I'm going to pull in 3 other companies and we're going to do a valuation using multiples. But I think maybe we should just take a break. So let's have a look at valuation now using multiples. So when we value a company using multiples, so first you check everyone can hear me. Just do a quick check in on the chat if you can hear me. Let me know. Great, thank you, Sahar. Thank you, Victor. Okay, so we're going to value Walmart using the method of multiples, and for your assignment, you're going to do this as well. So through our DuPont analysis of Walmart, we kind of got a feeling about how the company's performed. We can see that they are margins have improved. Let's just go back to our diagram here. So our margins improved for a few years. They've decreased slightly this year. We think there's maybe some scope for it to go back up to the 6% range. Sorry, the earnings growth margins have improved over this last 3 years. But their asset turnover has also been stable, but is less than Costco. So we've kind of got a bit of a picture of how they're doing. So I'd say Costco, just on the face of it, is probably a slightly stronger company than Walmart. I would probably, all things being equal, I'd probably be willing to pay more for Costco than for Walmart. That would be my gut feel. But let's have a look at the valuation. So what I've just copied here, this is from the question, just so we've got it handy, so I don't have to split a screen. So you want to do a multiples valuation of Walmart. You're going to do price to earnings, price to book, price to sales. And I've given you the input metrics, so your book value per share, earnings per share, and sales per share. So again, we're going to look at Walmart compared to other companies and its peer group to do the valuation. Let's just get this out the way. Okay, so we're valuing one Walmart share now, and we're going to look at other companies in its peer group. So I've pulled Costco, Target, and Loblaws. So Costco trades, the share price of Costco is around 14 times what the book value of Costco is. So book value is the equity on its balance sheet, is book value. The price to earnings takes the same share price. So the Costco share price is $915. So the Costco share price is 14 times its book value. That's equity per share on the balance sheet. It is 45 times its earnings. And it's 1.5 times the sales per share. Okay, and with the return on equity we did in the previous segment. So Target trades at much lower multiples than Costco. So 4 times book, 12 times earnings, 0.6 times sales. And then Loblaws is sort of somewhere in between. So its price is about 5 times book, price to earnings 22 times, price to sales 1 time. Just to give you a feel, the stock market on a whole trades at around 18, on the forward PE, trades at around 18 to 20 times earnings. So Costco, when I looked at Costco earlier, I said to you, I thought it was a pretty strong company. They've got a very good asset turnover ratio, high return on equity, and that's reflected in its valuation. The price is the highest out of its peer group on a multiples value. So Walmart, I think, should be somewhere in the middle of this range. It's not going to be as high as Costco, but it's probably better than Target. So let's just see, we're going to use this to get a value per Walmart, what we think the value of Walmart shares are, and Walmart's currently trading at $103 a share. So what we're going to do is use these ratios to give us a range for Walmart. So we're going to look at what is the maximum, the minimum, and the average of each of these multiples over here, each of these multiples. Okay, so we can use Excel to say equals maximum. What is my maximum price to earnings for my peer group? Okay, which I mean, it's going to be Costco for all of them, but this allows us, if you're working with like several companies, you don't have to go and like eyeball it. The minimum, we would do equals minimum in Excel of this range. And then we can copy that across. And then the average equals average. You've got to write it out in full for Excel. So we don't need this. Let's just make this fewer decimal places. Okay. So on average, so companies in the space that Walmart trades in, generally looking at our sample, trade between 4 to 14 times book value, on average around 8 times book value. On a PE multiple, it trades between 12 and 45 times PE, on average around 27 times earnings. So if I can now find out what like for example, Walmart, they've got a book value per share of 10 times. So their equity on their balance sheet on a per share basis is $10 per share. Shares in this industry trade at between 4 and 14 times book value. So 4 times $10 is about $40. 14 times $10 is $140. So that would give me a Walmart share price of between $40 and $140 if they traded a similar multiple to book value, and on average around $80. Okay, so what we're going to do here is we do this, what I sort of talked you through on the price to book, we're going to do it for all 3 metrics. So you start to get this like band of different valuations, and then you look for whether there's an overlap in the valuations on the different methods. So we've got the minimum and maximum. So now if we want to look at Walmart, so my inputs for Walmart are the book value, the earnings per share, and the sales per share. I'm just lining it up so that it's underneath. And the question gave us 1041, forward earnings of 294, and sales per share of 79.94. Okay, so those are our inputs. Now if I want to do the multiples valuation, I want to find out what is the minimum, the maximum, and the average. So the same that I had above. So if we look at book value, which I talked through earlier, so book value, if Walmart is trading at 14 times book value, so that would be 14 times its book value of 1041, it would have a share price of $148. If it was trading at 4 times the minimum of the band, it would have a share price of $43. And if it was trading at the average of its peer group, it would be 7.9 times book value. So if I was only looking at the book value as my valuation metric, I'd say the Walmart share price should be somewhere between $43 and $148, on average around $81. And it's currently trading, my current share price is just $103. But this is a very wide range that it's giving me. So if I had to sort of build up a table of this, just put it on the side here. Price to book. So in the videos, I spoke about a football field. So we're going to start building up a football field now. So let's say my valuations, I'll take them in $50 increments. So if I was valuing Walmart on price to book, it would be between 43 and 148. So I'm going to insert a box here. Where's my shapes? There we go. So it'll be around 43, so somewhere around here, to just under 150, somewhere around here. Okay, so my range, my valuation would be somewhere around this sort of 43 to 148 range. And on average, I'm going to just insert a star. On average, it's 81, which is sort of somewhere around here. And then we're going to do the same exercise for price to earnings and forward PE. So it's the same idea here. Okay, so if Walmart was being valued on a price to earnings method, my earnings per share is $2.94, so it's $2.94. The maximum of my comparables is 45 times, so I would say then it could be as high as $134, or maybe it's going to be at the low end of the range, so it would be $2.94 times 11.9 times, so that's $34. Okay, so I think if I was valuing it on a price to earnings, it would be between $35 and $134. So let's insert a shape for that as well. Oopsie, not a chart, a shape. So it's going from 34, so it's somewhere around here, up to 134. Somewhere around here. And I'll make it a different color. And my average here is 78. Okay, so let's put the star in for that. So it's just less than what we had before. So you can see already by adding in a second valuation tool, I'm narrowing my gap. So now my overlap is from 43 to 135. So I'm getting a little bit narrower. So what you want to do is layer on these different valuation methods so you can start to narrow in what you think the valuation should be. And you could do the dividend discount model as well to help you to start to get narrower and narrower. So that's why you use different valuation techniques. Let's do price to sales now. So why don't you try and do that on your own? How do I get the forward values? Okay, Ariane, you asked, how do I get the forward values? These guys here. I mean, is that what you're asking? Can you see it now on the screen? Okay, cool. Okay, then price to sales will do the same thing. Our sales per share is $80. Is it going to sell for 1.5 times, which will give me $190, or is it going to sell for $80 times 0.6 at the minimum, or is it going to sell for the average? Let's just make this all consistent formatting wise. And then we're going to do the same thing with price to sales. Let's insert a box for that as well. And that goes from 47 up to 120. So this is good because it's narrowing our range again, which is what we want. Okay, and what is our average is 82. Okay, so someone's asking, can you explain what these numbers mean? Okay. So let me just put it here. I've got price to book, price to earnings, and price to sales. Okay, so what this means is if I want to value Walmart, if we go back a few steps, so one of in one of the videos when I explained what price to earnings does, I said you want to buy a corner cafe, a corner store, and their earnings last year was $200. What would you pay for them? Would you pay $200? And I think in that example I said you would pay maybe like 4 times its earnings, because there was another corner store that sold recently also at 4 times its earnings. So if we take that and apply it to Walmart, if I was going to buy a Walmart share, I would say, what is a similar business to Walmart? So let's say Target, okay, is most similar to Walmart. So Target, the share price of Target is 11 times the earnings of Target on a per share basis. Okay, we could also do it on the whole business, but you're going to buy just one share, not buying the whole business. So Target sells for about 12 times its earnings, and with earnings we usually use forward earnings. You look at earnings to the next forecast year. So if earnings per share for Target, if it's selling for 12 times earnings, it must be the earnings per share will be 87 divided by 12 will be around, see, so Target's earnings per share is around $7.30 per share. So if someone's buying a Target share, they're going to pay around 12 times earnings. So that's how you get to the Target share price of $87. If we're trying to find what we think a reasonable share price for Walmart is, what we do is we look at these types of metrics for a whole lot of other companies that are in its sector. And that helps us to say, what do I think the Walmart share price should be? And then we'll once we've got what we think the Walmart share price will be, we can then compare it to what the actual share is trading at and say whether we think it's undervalued or overvalued. So if we look at the table that we've got here, this is called a football field, this diagram. I would say that the range that we're getting here is $46 to around $121. So the share price should be somewhere between 46 to 121, but that's a very wide range. So it's not super helpful, but the share price at 103 at the moment is quite close to the top end of that range. But if I look at the average of the averages, because the averages are quite tightly bound around that $80 space. So here, if I take the average of these guys, I get $80.97. And you can see here, these 3 red stars are clustered around $80. So my average of averages is 80.97. So I think based on this, looking at how Walmart, how Walmart's competitors or peer companies are valued, Walmart should be valued around $80. It's actually trading at $103. so I've got a couple of choices. So one thing I could do is say, I'm wrong, and there's must be more to the story that I don't understand, and to say, well, maybe their earnings growth figure is going to be much higher, and maybe their return on equity is going to improve. Maybe there's some story here that I don't know, that I haven't looked into it in detail. So that could be one thing, is like, I'm far out in my evaluation compared to what the market is seeing at $103. What am I missing? And if I look at the DuPont analysis that we had up earlier, like, I just don't know where their good performance is going to come from. Like, they'd have to get asset turnover up, but like, it's gone up. So like, is that going to grow? Or revenue growth, like maybe they'll get a big revenue growth, but it's not going to be, I don't know, maybe they've got something to grow revenue at 20%. I don't know. But it seems like everything is sort of maxed out. So I don't know where their strong earnings performance is going to come from. So one option could be to go and speak to the company, do more research. Another option could be to say, look, I don't have time to assess every company. I don't think there's an opportunity with Walmart. I'm going to move on to my next investment idea. Maybe I'm wrong and I've missed something on Walmart. So be it. You've only got 24 hours in a day. You can't look at everything in detail. So the type of analysis we're doing here is a good sort of quick way to look at potential investment ideas, to say, do I think this thing is undervalued or overvalued? When we looked at Walmart 2 years ago, it was much more interesting. And that was because it had this net income margin story happening. It had this very low net income margin. So interesting investment ideas come when something is like out of line and you think it's going to revert back to the norm, and that's often when you get the investment performance. So I don't know that from the chat if that sort of explains. There was a question to explain what these numbers mean. I don't know if that helps. Oh, the price part in the ratios means the share price. That's correct. Yeah. Okay. So what we're trying to do here is determine what the price should be for Walmart. And we've used these price to various metrics as a way of looking at it. So I'd like you to do something like this for the assignment as well. That's one of your assignment requirements. So you'll have your peer companies. When you do the DuPont analysis, you'll do that compared to the peer companies that you've chosen, and then you'll use those same companies to do the valuation. So the first part, the DuPont analysis, was a ratio analysis discussing the historical performance. The valuation here, these are ratios that we're using, but these are not performance ratios. These are valuation ratios. So they're used for a different purpose. So the valuation using the multiples is sort of part of like looking forward. Do we think we should buy the share? And the historical performance helps us to say, well, if things have gone particularly badly in the most recent year, I think that they're going to revert up to the norm in future years. So I think it's a good opportunity, or no, I think there's not much scope for improvement. Okay, so I think that was my main story here. In terms of where I got some of this information from, so let me just get a website up again for you. So this is quite a useful website actually, and we want to look up Walmart. Okay, so it's trading at $101 today. They're loading a chart. So let's just see if I call up the 5-year chart. So we can see here, I first started looking at this in 2023 and thought that there was a possibility they could get their margins right. If only I'd listened to myself. But I did not listen to myself, because I did the exercise for teaching purposes. But you can see the Walmart share price obviously had a big run recently, and it's sort of flattened out now. If we look here at the some of the data that they give us here, they've said here that Walmart is currently trading at a price to earnings ratio of $38 over here. Okay, and this is TTM, which stands for trailing 12 months. So this is looking at the historical, the last 12 months, whereas you actually should do a valuation on the forward 12 months. But even so, 38 times, I mean, that's up there with close to what Costco is trading at. Do you think Walmart should be trading that high? I don't know, probably not, but maybe they've got like huge earnings coming through next year and we just don't know about it. Earnings per share they're given us here. So this is the PE ratio here is the share price today, which is the 103, divided by the trailing earnings per share, 265. So that's how they get to the $38. What else is interesting here? The dividend yield. We spoke about dividend yield in class last week and the importance of dividends in valuation. So that's why they've given the dividend yield. And then the other thing was, where did I get my, I was going to try and remember where I got the forecast from. I think I got it from here. So there's other menus here of where they get information from. I've got to just try and remember where I got it from. Here we go. Yeah, so under analysis, this tells you what analysts are forecasting. So they've got here earnings estimates. So they've got the number of analysts that are looking at Walmart, what their average earnings is, high, low, and from what their forecast was a year ago. So their earnings forecast has gone up slightly from a year ago. But I wanted to use the forward earnings for 2027. So 2026, their year end is January. So we're almost all the way through that year. So I wanted to go forward. So I used the 275 in the valuation. Oopsie. Oh, actually I didn't use the low, I used the average, the 294. So that's where I got my my number from. The other thing that I wanted to mention is with retailers, let me just check if there's chats. One of the weird things that happens with retailers is, so this, we don't actually see this with Walmart, but you do see it with like Home Depot and some of the others. Nordstrom, for example, does this. So Nordstrom will talk about their year as 2024. So they'll talk about fiscal 2024. But what it actually will be is the year ending Jan 2025. Okay, just the way it's just the way Nordstrom does things. So often you'll find with retailers, they tend to have their year end when it's a quiet time of year. So that's why we see Walmart has January year ends. So it's quite common for retailers because they don't want to do their year end around Christmas because they're so busy with other stuff. Things get very quiet in January, February. So that's typically when they'd have their year end. But for what Nordstrom does is they say most of our trading, if I have a January 2025 year end, most of my trading actually happens in 2024. So they call it their 2024 year, even though it's actually the date is January 2025. Walmart doesn't do that. Walmart actually says the year, which is mostly 2024, but ends in 2025, they actually call it January 2025. So that's just something to look at. Sometimes it can be confusing when you're reading financial statements. Just check what year they're actually talking about, particularly if it's a January or February year end. The other thing we find with retailers is that they, actually I need to share this anymore. They will often talk about a 52 versus a 53 week year. So again, Walmart doesn't do this. So Costco, I think, does do this actually. Let me just check what did I put for the Costco dates. Yeah, so if you look at, let's just share Costco. Okay, so if you look at Costco, so Walmart January 2023 is, I mean, January the 31st is always their year end. Costco, can you see that they bounce around? It's like sometime at the end of August. Okay, so it's like in 2020, it was the 30th of August, then the 29th, and the 28th, and the 3rd of September, 1st of September. So the way they do it is their year end is the Sunday that is closest to the end of August each year. So that's why it keeps moving around. The other thing is that and they work on what's called a 52 or 53 week cycle. So they'll say a year is generally a year on average is 52 weeks, but a year isn't exactly 52 times 7 days. Okay, 52 times 7 is 364. A year is 365 days, not 364 days. So they work mostly on a 52-week year, but then every now and then they've got to catch up that extra day that they've lost over a few years. So every sort of 5 or 6 years, they'll have a 53-week year. They'll tell you about it in the financial statements. It'll say this is a 53-week year. But when you're analyzing the company, just make sure you know whether you're comparing a 52-week year to a 53-week year, because one of the years might have an extra week in it, which obviously will increase revenue slightly. It'll probably improve margins slightly, things like that. Usually the extra week is in a quiet time of year, so it's not a huge impact, but it is there. It'll be in the numbers a little bit. So Walmart doesn't do that, but Costco does do that. So it's just kind of an interesting thing that you find in the retail sector. Okay, and that was my story for today. So this week's class is always finishes a little bit earlier, but we think just before the midterm is probably a good time to have a slightly shorter class after all your long classes the last few weeks. And today's class was about taking you through these tools that you will see quite commonly, and then your assignment gives you the opportunity to apply what we've done here. So next week, there aren't classes next week because it's your midterm is next Friday. So no classes next week, no tutorials next week, but there are tutorials this week. Okay, any questions? Okay, I will stop the recording. And then if anyone, I can still hang around if anyone's got questions. So I will